crystal ball is broken, and so is everyone else's that's telling you what they really think is going to happen. It's just opinions, right? Either one of those things could happen. But here's how we as real estate investors should react to these things, okay? And what we should prepare for. What's going on, guys? This is Matt Fairclough here, and this is a segment that we pulled off of our DeRosa Insiders community, which is a free community on Facebook. On that community, people ask us questions when we go live on every Friday, noon Eastern. This is a brief segment from that series. Lots and lots of great stuff gets talked about, and a lot of it's exclusive for just the Insiders community. We'll give you guys a little taste of it right now so you guys can learn with us too. We hope you guys can join us on Insiders. Go to Facebook right now, click the link in the bio or the description below to join us on Insiders, and we'll see you there. So guys, today's topic is going to be about interest rates, because interest rates are likely going to change very soon. They've been going up a lot. And there are some theories out there, that interest rates are going to go down, right? Some folks have said for a number of reasons. Here are some theories, right? Nobody's got a crystal ball. Somebody really knows what the Fed's going to do. Give you a few theories that I've heard, right? The government can't afford to pay its own debt anymore, or its own debt's going to become more and more expensive as the short-term debt that it has, short-term treasuries start to expire, and the debt becomes more and more expensive because one-year treasury was this much, a little over a year ago, and now it's this much. So as the government's debt starts to come due and they have to refinance that debt, which is what they do, a bond becomes due and has to get paid back. What's the government do? They just write another bond, but the interest rate is going up and up and up. So as the government's debt comes due and they have to refinance it, the government's not going to be able to afford its own debt. And which is, interesting philosophy. And some theories have said the government's debt expense is going to go well over $1 trillion, which is more than 25% of what the government's revenue stream is. So 25% of every dollar, 25 cents on the dollar is going to go to maintain the government's debt, just to maintain it, not pay it down, just pay those treasuries. So the theory is the government can't maintain those high interest rates because it can't afford to pay its debt long term. That is one theory. Other theories are that the government has done what it wants to do, which is to slow inflation. And so that's going to kind of start to take effect, and the government's going to start to see a recession. How do they fight a recession? By dropping interest rates, right? And so the theories are that rates are going to start coming down because of a weakening economy and because of inflation being kept in its place. So that's a theory. Other theories are that inflation has not been tamed, and that there's lots of under the sheets inflation that's out there. And you could point to all kinds of different things as to why inflation is not quite tamed yet. And the government is not done raising interest rates. And so the other theories are, again, crystal ball looking here, is that the rates are going to continue to increase. And we could be looking at another 50 basis points to even a full 100 basis points of rate increases, right? Again, I don't know. So again, my crystal ball is broken, and so is everyone else's that's telling you what they really think is going to happen. It's just opinions, right? Either one of those two things could happen. But here's how we as real estate investors should react to these things, okay? And what we should prepare for. If rates don't go up anymore, or if they start to drop, what that's going to do is it's going to fuel the economy, and it's likely to be because of a pending recession, or because people think that the economy is teetering and is going to be on its way back down, right? So what that's going to do is it's going to fuel growth. You're likely going to see a spike in real estate activity, because let's say the government drops the interest rates by 50 basis points, which is slang language for 0.5%. I'll talk in plain English, right? 0.5%, 0.5%. If they drop that, that will flow into the residential real estate market. So that means single family homes and that kind of thing. A lot of folks looking to sell single family homes have been sitting on their houses. Ask any realtor and they will tell you that Q4 of last year and Q1 of this year have been one of the worst years for real estate transactions, for refinances and sales. The only people that are selling their house are those that have to. The only people that are buying a house are those that have to. People are sitting because they don't want to pay the drastic interest rate hikes that have happened, or don't want to sell into a market where they wouldn't be able to sell for as much as they would just a few months ago, right? So you'll see people saying, oh, geez, party on switch just got thrown. Let's get back in. So you're going to see a spike in residential home sales, real estate. For those of you guys that are fix and flippers, good for you. For those of you guys that are looking to sell your own primary residence or refi or whatever, good for you. Any of you that has floating rate debt vehicles, such as home equity lines of credit, real estate on floating rate, bridge debt, what are those kinds of things, good for you as well, because you may see a decrease in your debt service and your cost of debt for your property. So that's if interest rates go down, you're going to see a bump. And if you bought anything in the last year, then it's going to bump in value. Again, this is Matt's professional opinion. I don't know, but this is what I think is going to happen if they either don't cut rates at all, or if they decide to cut them a little bit. I think a stagnant rate is kind of viewed as, hey, we've hit the ceiling. And I think that you'll start to see things that start to bump. right? If you're a Wall Street investor, which I'm not, but if you're a Wall Street investor, then you will certainly see Wall Street have the biggest party you've seen in a long time. If they cut rates, you'll probably see the stock market, the Dow jump at least 10% over a couple week period. Again, my prediction. You're going to see a short-term party, but people need to realize the reason why you're seeing that is because those that are smarter than you and I, the Fed and Department of what you think, and I'm not making any political opinions here, those that are making these rate decisions likely have a lot more data than you and I do. And so they're seeing something coming. They're like, that doesn't look good. So let's drop the rates to take the pain off, and so that people can get ourselves through this tidal wave that's about to show up, right? So I think you're going to see a short-term party, but whatever reason they're dropping the rates is because something either bad is happening or because something bad's about to happen. So you're going to see a short bump followed by probably some pain that they foresee, right? So a recession, like lots of job losses that they might predict are on the way. Maybe a lot of companies are going to start missing earnings. You start seeing that. You start seeing missed earnings, that's when the Wall Street party decides to stop. And if you start to see the Wall Street party start to stop, meaning the stock market, because of companies missing earnings, saying, we thought we were going to earn this, but because of the recession, because of inflation, because of we now earn this, that's when the stock market's going to start to realize, hey, man, they weren't kidding. This thing's really, the economy's really softening. Then you're going to see a fall off. And that's when they'll probably will drop rates, and that'll affect real estate a good bit. But there's another machine that'll affect real estate more than interest rates, which is the economy. The economy dropping will affect our tenants' ability to pay the rent. It will affect the revenue side of our business on all fronts. Softening economy is not something that's good for anybody. It just probably makes it maybe a little bit easier to find deals, but it's going to make it harder to liquidate those deals or to sell them or to monetize them through rents or whatever it may be. So nobody should be praying out there for a really soft economy that's going to be elongated, right? That's my comment on rates going down, right? Little bump in the party. If you got something you've been waiting on selling, you might want to sell right then because there's probably a tidal wave coming right behind it. That's Matt's thoughts on that. If the Fed decides to do something Looney Tunes like nobody else is thinking they're going to do, which is increase rates to keep things going up, like, no, they can't do that. They've already increased it quite a bit. Well, they love to surprise, right? They may increase rates again. And the reason they would do that is because they see more data that shows inflation is still not tamed, and that they see that the economy has still not behaved itself, and we're still having too big of a party from all the money we printed the last couple of years. That could be what happens. And if that is what happens, what you're going to see is probably not the best thing in the world show up on the real estate world. And it's probably going to be a lot more pain. And a lot of folks that I've talked to in the real estate world believe that we're done. And so if we're not done, it's going to cause more and more issues, especially on the residential housing market. In the commercial real estate world, here's why dropping rates are not going to affect much of the debt service for us, for the DeRosa group, or for us as in the collective us, like you guys, me, or whatever. Most real estate investors have this thing called a rate cap. That is like, if your interest rate, you bought a property and the interest rate was 4% and the rates jumped to like 10, whatever. There is an insurance policy you have that says that, okay, you're paying 4 right now, but there's an insurance policy called a rate cap that says the most you're ever going to pay is 6. You can bump, but only but so much. What that means is that rates can go up, but only to here. And if the Fed drops rates, then if they increase rates or drop rates, we are still likely operating inside the rate cap, meaning like the rate cap is paying. And so we're still, the rates that the market would charge us are still well above what our rate cap insurance policies have us at. So for like DeRosa, our rate caps are conservatively low. And for most of the folks out there, I hope yours are too, you're likely not going to see a major effect on commercial real estate. The only thing you will see is rate caps get more expensive for those people looking to buy properties. If the Fed increases rates further, you're going to see more pain come to people looking to buy. If they're illegal to buy under fixed rate debt, that money just got even more expensive. And if you're looking to buy on floating rate debt, I don't know why you would do that in today's market, but if you were, your interest rate cap just got that much more expensive. So it's going to make the cost of debt more expensive, which maybe, as I think about it, as I'm thinking out loud here, might make more deals fall out. So maybe if the Fed increases rates again on the commercial side, I'll adjust my opinion to include that, is you'll likely see more deals that are under contract fall apart. So, and maybe that'll cause sellers to get more realistic. Maybe we'll see finally the correction we've all been waiting for on commercial real estate. So maybe that's something that we all would benefit from long-term for those who are looking to buy apartment buildings, looking to do other commercial size deals. Maybe, I hate to say this, maybe we all need the Fed to bump it one more time, and that will finally cause the sellers and the brokers, is for that matter, to get a little more realistic on the pricing and on the cap rates that they're charging on properties. So that's likely what will happen. Yet again, crystal ball's broken, so I don't know what the Fed's going to do. That is our current event of the week. We're going to be doing more current event conversations. We've already talked about stuff like, we talked about the SVB collapse. We talked about the major foreclosure that just happened in Houston. If you guys have other current events you'd like for us to talk about on the show, please post in the comment section, and I will talk about whatever current event you want. Whatever current event you got, I will talk about here right on this channel for you guys. If you guys like these conversations, if you guys guys want to join me and ask real live questions of me and the DeRosa team for things that we talk about, real live events, make sure you guys go to Facebook right now and join us at DeRosa Insiders. That is DeRosa, D-E-R-O-S-A, and join us for our free Facebook community where I go live Fridays at noon Eastern, me or the DeRosa team, so you guys can join us live. See you then, guys. If you like this video, here's a few more you might like too. Thanks again for watching. Make sure you subscribe and like this video.